Hey, Jordan, it's Phil.
Hey, how's it going?
Not too bad. Nice to meet you.
Yeah, nice to meet you.
Hey, I do have to apologize. We really didn't do the best job in promoting this for you, so we probably should rerun it maybe, right after Thanksgiving.
Okay.
So just to kind of give you a heads up on that. So not sure how many people we're going to have popping in here, but
Sure.
do you have
Yeah,
a
well, I mean,
present?
if we get a few, that'll be great. And if not, we can always rerun it.
Absolutely. Hey, Michael, how are you?
Hey, good. How are you, Phil?
Not too bad. What's going on?
Not much.
I like your headphones.
Thank you.
Cool. Um, so maybe we can do you want to wait a minute or do you want to start or let's see if there's anybody usually just pop in.
Yeah, we're flexible. So, I mean, if you want to wait a couple minutes, we can wait, see if anybody else jumps in. If not, we can always run through it.
Hey everybody, how are you? We're just about ready to get started. We've got Jordan Long here and Michael Elliott. So um, appreciate everybody being here. We'll kind of keep the um, we'll save the questions till the end. You might want to put them in the chat and Jordan can open that up. Jordan can answer them once you have them. So we'll kind of get going.
Perfect.
All right, great. I shared my screen. Can you see that, Phil and Jordan? Can you guys see that?
Yep.
Absolutely. Yep, looking good.
All right, fantastic. Hey, everybody. Thanks so much for having us today. My name is Michael Elliott, and I'm a CPA. And my team and I, what we do is we work exclusively with real estate agents on their accounting and their tax. We help agents just like you keep more of what you earn and get rid of the stress that kind of comes along with a busy tax season.
Perfect. Yeah. And I'm Jordan. I've been a real estate agent for over 10 years now. Actually, hang my license, Dalton Wade. I've owned short-term rentals, fix and flips, apartment complexes. So I've gone through the headaches during tax season myself. Yeah, when I first started out, I thought, hey, I know I need to sell real estate and invest in real estate, but I didn't think much about the tax side of things or the bookkeeping side of things, at least.
Yeah, and that's most agents. Y'all are incredible at helping your clients build wealth through real estate, but no one ever really teaches y'all how to treat your business like a business.
Exactly. That's what we're going to talk about today. Just practical, high impact moves that we can make before December 31st. So these are things that we can do right now that'll set us up to pay less taxes and feel organized going into the new year.
Yeah, we call this session, we call it the smart moves that pay off big because a lot of what we're going to talk about tonight isn't complicated. It's just small strategic steps that we can take that really help to build wealth. So here's what we're going to dive into today. We're going to talk about first how to maximize our deductions. So that's the money and the expenses that most agents are taking. We're going to talk about how to simplify our bookkeeping so that it's not overwhelming. We can't promise we're going to make it joyful, but we can make it maybe a little bit less overwhelming. And make sure you're tracking everything correctly so that you can deduct it. We're going to talk about when an S corporation might make sense for you. That word gets thrown out around a lot, so we're gonna hit on that. We're going to talk about a couple of sort of high impact year end strategies that you can still use this year before it might be too late. We're going to talk about how to plan for profit so that your business pays you first.
Perfect. Yeah. And we most of these we normally do interactive, but I think Phil, like Phil said, if you have questions, throw them in the chat. If we see them along the way, we'll kind of address them. And if not, we can do a Q&A towards the end.
Yeah, absolutely. So let's start right here at the top with something that we know everybody cares about, and that's tax deductions. So here's the truth: every single year, real estate agents they leave thousands of dollars on the table, and it's not because you don't qualify for deductions. It's simply because you don't have the right systems in place to track and to claim every deduction that you're entitled to. So the tax code, it's actually full of opportunities for business owners. And believe it or not, the IRS doesn't intentionally try to hide deductions from you, but it does require you to know where to look and to document those deductions. And not only that, but honestly, sometimes the IRS instructions, as a CPA who's prepared thousands and thousands of tax returns in my 15-year career, I can tell you the instructions are not super clear. The tax code with pages of code and regulations is over 100,000 pages of code. And it's not super clear all the time what's deductible. And so it takes good, organized work in order to claim everything that we're entitled to as agents.
Yeah, and that's what I found over the years. If I don't have a system in place to record my deductions, they end up missing a ton at the end of the year.
Yeah, that's exactly right. You can work 80 hours a week, but if you can't prove your business expenses, you're really going to be missing out. So let's hit on 4 or 5 sort of common deductions that all real estate agents likely should be taking. And some of you will be taking these. We hope to maybe add a little bit of extra value and nuance here. But a lot of agents we have found are missing some of these deductions. So we're going to start with one very popular one. It's the mileage deduction. It's still one of the biggest missed deductions, even though it's one of the most powerful. You see, every business mile that you drive for your business is worth, in 2025, it's worth 70 cents a mile. Now that adds up really, really quickly. So for example, if you drive 10,000 miles for your business, that's a $7,000 tax deduction. And so if you multiply that by 20 or 30 or 40% income tax rate, you can see that it's thousands of dollars worth of deductions. And honestly, not only is this an often missed deduction, but it's a deduction that if you were ever audited, it's subject to a lot of scrutiny. The IRS, they have very strict rules relating to the documentation that's going to be required in order to claim the mileage deduction. And that documentation, I'm going to roll through a couple of things, but that documentation includes having a mileage log that's going to show the date of the trip, where you started from, where you went, really the odometer, so you know how many miles that you drove, the purpose of your trip, etc. And while it might seem a little daunting, man, I got to collect all of that data in order to take the deduction. It's very important. I can't tell you the number of times that I've had clients, they call me up, it's March 15th, right? April 15th. I'm working on a tax return to say, hey, you're missing your miles. How many miles do you have? And the answer almost always is something like, well, I drove 10,000 miles for business last year. Now, while that number might be correct, and for agents, let's be honest, a lot of y'all are probably driving 10,000 plus business miles every single year. The reality is this, is if that person who just says, I drove 10,000 miles, and maybe that's you, if you were ever audited, IRS is simply not going to take your word that 10,000 is sufficient documentation. But here's the good news. The good news is there's some incredible programs out there that are smartphone apps. You can just install them. They're really cheap, just a few bucks a month that you could download. One of my favorites is called Mile IQ. So Mile and then the letters I and Q. It's just an app. It automatically starts whenever you start driving, and it'll ping you. It'll little pop up, say, is this a business trip? What's the purpose? These kind of apps help you create those mileage logs so that you can track that A, you can track the miles, but B, you've got the good documentation. So mileage, an incredibly powerful deduction a lot of agents miss. The next one, home office deduction. Man, if you got a dedicated workspace, something that's used exclusively, and the keyword here is exclusively for your business, even if it's just a small corner of your house or it's just a desk in your house, it can qualify for the home office deduction. Now, the key to this deduction is that your home office has to be used exclusively for work purposes. Now, what that means is that if you share your office with a spouse for their hobby, or maybe you've got another business that's in there and you're kind of commingling there, then that space would not be considered exclusive. So what we recommend is that all real estate agents have a dedicated space in your house, even if it's just a small desk, that we can exclusively say is your office space so that we can claim the home office deduction. Now, here's why this is so powerful. It's powerful because the home office deduction, it allows us to take a percentage of our total household deductions against our income as an expense based on the square footage of the office. So for example, if you have a 200 square foot home office and your house is 2,000 square feet, you're entitled to take 10% of your home related expenses against your income as an expense. Now think about this. That's mortgage interest, real estate taxes, insurance, maintenance on the house, your HOA dues, your utilities, and the list goes on and on and on. So you can just imagine how big of a deduction that could end up being if you've got a very large home office in your home. It's incredibly powerful, but the key is it has to be an exclusive space, and we have to be tracking those deductions carefully. Now, two other points I want to make. The first is that that deduction is available even if you have another office, right? So even if you pay and you rent a little space, you can still have a home office deduction. And it's also available if you rent your home. So if you rent your own home, you can still take a percentage of your rent as a home office deduction. Home office deduction, incredibly powerful. We're going to circle back to it in just a minute because there's a few misnomers about the home office deduction being a red flag I want to hit on. The third one, meals and gifts. Meals and gifts. Every real estate agent I have ever met loves meals and gifts. Every accountant I've ever met loves meals and gifts as well. But here's the thing. Meals are 50% deductible. Now, they're 50% deductible whenever business is discussed, and gifts are going to be limited to $25 per client. Now, I want to talk about a couple of things there. One, it's really easy to convert your meals to business expenses, meaning just make sure that there's a business purpose to the discussion. Jordan can tell you, he's been out to dinner with, he and his wife have been out to dinner with my wife and I. And every single time I go to pay for my dinner, I always tell my wife, I always say, you know what, Kristen? I said, business is good. And Jordan at first is like, why do you say that every time? I'm like, because if she's ever questioned about what our discussion was, she could always just say business is good. So make sure you have a business related discussion. The meals become deductible and they're 50% deductible. And then gifts are going to be limited to $25 per person. Now, we got this question from a lot of real estate agents, and they say, but Michael, every gift I ever give my clients is more than $25. So here's a couple of ways that you can get around the $25 loophole that I think are kind of a gray area. So the first is it's $25 per person, which means that if you're giving to a couple, so a husband and wife, for example, you could give them a gift worth $25 each, so a total of $50. That's the first thing. The second way that we kind of oftentimes look at getting around this is that if the gift is actually a marketing type expense, meaning you're putting your advertising, your branding on there to get referrals, for example, we would call that a marketing expense and not a strict gift. And in that case, marketing expenses are fully deductible. And I've never met a real estate agent that is not constantly marketing, branding themselves, looking for leads. And so most of the time, this kind of $25 limitation is really going to end up not being very applicable. The next one here seems to be intuitive, but there's a couple of little nuances here. It's education and coaching. Your CE courses, if you're taking, so seminars like this, some of you guys are paying for seminars, even professional coaching, if you're hiring maybe a sales coach, all of those expenses are deductible, and they do seem fairly straightforward, but you should keep something in mind that if you got mileage on the way there to those education and training courses, that mileage is going to be deductible. The Starbucks coffee that you're drinking on the way in is probably going to be deductible, at least 50% as a meal. The notebook you got to pay to take notes, all of those sort of ancillary costs that go around education and training, those are going to be deductible. Make sure you're tracking those. And finally, marketing. Everything from signs and staging to Canva, social media ads, your website hosting, those are all deductible. And it's super easy to sometimes forget about the various sort of smaller marketing type expenses that you might incur. We all know an agent, probably ourselves, that has swung by Walmart on the way to a listing to pick up supplies. Maybe you threw it on the personal credit card instead of the business credit card. Those are still deductible expenses. Maybe you bought something on Amazon, you got shipped in for an open house, it's on the wrong account, right? That's still a deductible expense. We need to make sure that we're tracking those things. And what we do is we always are encouraging agents to sort of get into the habit of using their business card if possible for all of our business expenses. And we'll talk about this in a minute so that we're not missing out on deductions.
Yeah, the key here is keeping good records. Most agents lose money simply because they don't keep the receipts or track the details. So if you get nothing out of this section, just remember, you can't deduct what you can't document. So many agents are not tracking these items closely enough, and they're leaving thousands of dollars on the table just from not documenting.
Yeah, and I want to circle back to the home office deduction because there's a big myth here relative to all business owners, but especially real estate agents. Probably the biggest myth that I've heard in my 15-year career as a CPA is that the home office deduction raises red flags. And I hear people say all the time, I hear agents say, I don't take the deduction because it's too big of a red flag. And to be honest, maybe that was true 20 years ago. I haven't found that to ever be true in my career, but maybe it was true 20 years ago. But the reality is now that we live in a day and age when the home office deduction is not only not a red flag, but it's expected by the IRS because, post COVID, almost everybody has a home office. Everyone's claiming or should be claiming the home office deduction. And to be quite honest with you, in my career of seeing clients audited, I actually think the mileage deduction is a substantially bigger risk area than the home office deduction. So as long as you've got that dedicated space in your house, should it be a red flag at all? And I do want to throw this out there just in case maybe you aren't taking the deduction because you are nervous. There's actually a simplified version of this deduction that became available starting about 4 or 5 years ago, where you can just take a flat dollar amount based on the square footage of your house, where you're not having to track all of those maybe personal household expenses. So if you're not taking this, and your accountant is open to the discussion, maybe think about asking about the simplified version of the deduction because it's just a lot easier to keep track of. And if you are nervous of red flags, the simplified version clearly is not one. So what I want to do though is I want to repeat something that Jordan said, and that's this, what we call the golden rule of deductions. You can't deduct what you can't document. Even good, sort of appropriate deductions, like legitimate deductions, are completely worthless if you can't document them. If you don't have the documentation to prove what the expense was for, that it was for a business purpose. I mean, I've seen in audits, sitting down with IRS auditors, where the IRS auditor will say something like, Michael, that the client clearly incurred that expense, right? Like, I know, the IRS auditor says, Michael, I know that they likely had $5,000 in marketing expenses. They understand that. But they are going to deny the deduction to the taxpayer if the taxpayer doesn't have that sort of sufficient documentation. In the tax world, this is a little technical, but in the tax world, what we say is that the burden of proof falls on the taxpayer, not the IRS. The IRS doesn't have to prove you don't need the deduction or you don't qualify. You have to prove that you do qualify for the deduction. So that's what we call the golden rule of deductions. You can't deduct what you can't document. And we thought about putting a picture of a mean IRS auditor here, but we just thought golden retriever puppies were probably a much better example of the golden rule of deductions. And so here's what we recommend. We're going to dive into this. Create a system that allows you to track your deductions in a way that works for you. If you're a visual person, man, be taking pictures of your receipts, keeping them in an album on your phone called Tax Stuff. If you're a digital person, use tools. We're going to talk about QuickBooks Online or Xero or even a shared Google Drive folder. The simpler your system of keeping track of things is, the more likely you are to stick to it. And that's what we have found really separates the agents that are maximizing their tax savings for the ones who are simply overpaying on their tax returns every year. And like we said at the beginning, it's often not just the hustle that separates the good from the great agents. It's the hustle combined with good systems and good processes.
Perfect. All right, so let's jump into a little bit of bookkeeping. I know this is where most of you guys probably want to take a nap, but stay with me because bookkeeping is where the stress of tax season goes away if you do it. So when your books are messy, you're guessing. You don't really know how your business is performing. But when you keep up with your books, even just once a month, right? Like if you're not saying, hey, I'm doing it every week, but even just once a month, you'll actually see what's working and what's not. But I understand that bookkeeping is often one of the first things that agents drop when they get busy, when they start doing a lot of deals. And the reason for that is that most agents don't have a clear and simple system for bookkeeping. So when it's confusing, it's just not easy for them. Well, while it might seem boring, bookkeeping actually does two different tasks for us. First, it provides you with a good systematic method for capturing all of your allowable expenses, which at the end of the year will allow you to minimize your tax obligation, And the second thing that bookkeeping does is allows you to understand how your business is doing.
Yeah, we really need to think about bookkeeping more like checking the dashboard of your car. We don't wait until our car breaks all the way down before we take a look at the dashboard, right? We're glancing at it from time to time, just making sure that everything is running right, like looking for that check engine light. Or here we're located in Florida, temperature got cold, all of our car lights are going on saying our tire pressure is low, right? We're looking at that to see how things are going, just like the dashboard of the car. Because I can't tell you the number of times we've worked with agents who thought that they were doing well financially, who thought they kind of had things together because they kept making sales, commission income keeps coming in, only to have me, the accountant at the end of the year, really look at their records and have to let them know that, hey, yeah, you've been making sales, but your expenses, right, are much higher than your revenue. You're actually not doing so well. That's putting your accountant in quite the uncomfortable position, let me just tell you. In fact, even if you're not the best bookkeeper in the world, like even if you're doing just sort of a mediocre job at working on your books, anything in your bookkeeping puts you in a substantially better position than someone who doesn't put any time, energy, or attention into their bookkeeping at all.
Yeah, I agree. I mean, it's not about perfection. It's about visibility into your numbers. So even if you're just starting with basic stuff, get you leaps and bounds ahead. So we have a few rules here. We've created a little bit of a system that we believe works well for real estate agents. It works because it's simple and repeatable, yet complex enough to help you get insight into your business and properly track all your expenses. And there's four main pillars to this system that we have. The first one is we recommend separate accounts, using one business card, use software to track, and do a 15-minute review. So that's all you need to do to stay organized. And the most basic and fundamental element of this is the idea of having separate business and personal bank accounts. That means that you have a checking account for your business and one for your personal expenses. And you pay all of your business expenses through the business account and all the personal expenses through the personal. But mistakes happen. I get it. I do that as well. But having these accounts separate is key to having good bookkeeping. The second element is have one dedicated credit card for business. Ideally, this would be a credit card in the business name. However, if you'd prefer to have just a personal card and not a business card, that works too. Just be sure to keep all of the transactions, all your business transactions on that one card. Don't bounce around from card to card. And if you get the habit of always using your business card for business expenses, you'll be less likely to lose legitimate expenses because you paid for them on your personal card. And if you're prone to forget which card is which, you could be like Michael. Michael always says blue for business because he doesn't have two business cards. So you just look blue for business and he knows to put the business expense on the blue card.
Yeah, that's exactly right. I'm a simplistic guy. You can be simplistic like me. Have one personal card, have one business card. If you track everything on that business card, you're a lot more likely, more likely to claim your expenses and a lot less likely to miss them. Now, the third component of sort of our simplified bookkeeping plan, it shouldn't be seen as groundbreaking in any way. This is simple stuff. And that's to use software, right? This is 2025. We should probably be using software for just about everything, especially our accounting and our taxes. Now, accounting software, if that scares you a little bit, it's gotten super, super good at helping us to track our data. What we recommend that all real estate agents use an online bookkeeping software. Our personal recommendation for agents is QuickBooks Online. There's others out there, but we have found that to be just such an incredibly powerful piece of software. What it does is it connects our banks and our credit cards directly into the software. So as soon as you go and swipe that business card, that transaction, as you know, shows up in your credit card account. And then as soon as it shows up in the credit card account, it syncs right into QuickBooks and shows up in your QuickBooks account. And then you can easily go in there and tell QuickBooks that expense was for gas, or that expense was for marketing, or that expense was for whatever. It's real time. QuickBooks Online is getting even better. There's artificial intelligence being built into it. So as the AI agents inside of it are getting better, it's going to automate a lot of this. You can set up rules to help you make it more quick. So as soon as those expenses are being swiped by your credit card, they're showing up in your accounting software. You're not going to be missing many deductions. And honestly, here's what we found is that most agents who set up good systems are going to be able to do their bookkeeping in less than 5 hours per month. So if you're spending more than 5 hours per month, you probably should be a little bit of a red flag for you. And honestly, most agents are going to be do this in less than 2 hours per month. And you can also attach copies of all of your invoices, your receipts, and things like that. You can upload those directly into QuickBooks Online, attach those to the transactions. That way, you're not having to save them in a separate file folder. They're automatically attached inside of your QuickBooks Online. Now, the fourth and final kind of simple step here in our bookkeeping system is that 15-minute review. Well, here's what we do. We recommend that all agents, after they complete their monthly bookkeeping, take just 15 minutes to review your numbers. Using QuickBooks Online, you can run a profit and loss report. Shows your expenses or your gross income minus your expenses. You can run that report for the prior month. You can run it year to date. Like we could be looking right now at October's numbers, or we could be looking at January through October. But then we can also do some fun stuff using software. We can compare this year against last year. We can see how this month was against last month. All sorts of reports that you can look at. You can also run balance sheet reports, which are just statements that show the items that you own as a business, the expenses, the liabilities, the things that you owe from your business. We often get asked, though, when should I do my bookkeeping? And I can tell you the one answer of when you should do it is not in March for the prior year. That's when you shouldn't do it. What you should be doing is you should be doing your bookkeeping every single month. And what we recommend is you do it in the first 15 days of the month following the month, meaning you should be completing your October bookkeeping sometime between November 1st and November 15th. What that does is it allows you enough time so that you're not stressed. You got 2 weeks to do your bookkeeping. So you got enough time in there to get it done, but it's not so long that you forget what happened in the prior month. So do it in the first maybe 2 weeks of the month.
Yeah, and that's it. The separate bank accounts, use one business card, accounting software, and a 15-minute review. Those are the four foundational pillars of simple bookkeeping system that we believe real estate agents can use to make sure they're not only tracking their deductions, but giving themselves the data they need to make sure they're running a profitable business.
Yeah, for sure. So now we're going to transition away from deductions to maybe a slightly more complicated, but equally powerful component, and that is business structure. Now, just to be clear and honest right here up front, Jordan and I are not attorneys. We don't play attorneys on TV. We are in no way providing you with legal advice. However, talk to your attorney. But what we are going to do is we're going to provide you some insight. We've worked with thousands of clients on structure and dozens of attorneys throughout the year. So we have an idea of how structure impacts from an income tax perspective specifically. Now, we're going to be talking about specifically S corporations because it's honestly one of the most misunderstood areas for real estate agents, because you're going to hear people say all the time, you've got to become an S corp. You got to become an S corp because it's going to save you money. And that is oftentimes true, but it's not always true. And we got to make sure we're doing it at the right time. But before we jump into sort of the tax benefits of becoming an S corporation, I want to back up and just talk for a second about what a legal entity is and why it's important. So legal entities are given to you by your state. You can be a corporation or an LLC. There's a couple of others, but those are the two most common ones. Now, depending on your licensing jurisdiction, you may or may not, as a real estate agent, be able to operate as an LLC or as a corporation. So, of course, you're going to need to talk you're going to talk to your brokerage. You're going to try to understand if you're allowed based on your state. You may have to get legal counsel, but if you are allowed in your state, you may be able to be an LLC or a corporation. So a couple of things and reasons why that is important. Here's why legal entities are important if you're allowed to be one, is it provides some layer of legal protection around your business, okay? So that's the first kind of benefit that it has. But the second benefit that it has is it potentially allows you to maximize the tax code in a sort of complex but very interesting sort of ways. Now, when most agents are sort of starting out, most do not actually set up a legal entity. Many simply operate under their personal names. Now, it's not super advisable if your state allows you to be an entity. We don't advise it because there's some sort of negative tax ramifications to it. However, many do operate under their personal name. Now, notice that so far in this discussion on legal entity, we have yet to talk about S corporation. So here's what an S corporation is. An S corporation is actually a subsection of the Internal Revenue Code. And what it lets you do is it lets your business entity, that LLC or that corporation, it lets it file income taxes using a somewhat, more advantageous tax structure. Now, in order to become an S corporation, the first step is we have to have a legal entity. So you've got to be an LLC or you got to be a corporation. If you're operating under your personal name, S corporation is simply not going to work for you. Now, most agents who are eligible in their state will become LLCs. And when those LLCs reach a certain threshold, which we're going to talk about, electing S corporation status is incredibly beneficial. So here's where S corporation comes in. If you elect to become an S corporation, the income from your business, right, your gross income minus your expenses, that net profit from your business, it moves off of your personal return and it goes onto its own separate business tax returns. S corporations, oftentimes LLCs being taxed as S corporations, what they're doing is they're then required to pay a reasonable salary to the employee. Now, let me back up for just a second and remind us all how our income is being taxed. If you are an LLC or a sole proprietor, meaning you're filing under your personal name, here's how your income is taxed. If you make $100,000 net profit, that's your gross commission income minus all of your expenses equals net profit. If you got $100,000 in net profit, it's being taxed like this. The first thing it's being taxed with self-employment tax. That's Social Security and Medicare tax. And that's around 15%. So right off the bat, you're going to have a 15% self-employment tax. In addition to that, you're going to pay ordinary income tax. Now, ordinary income tax is going to be based on your tax rate, how much income you made, other income on your return, maybe you got spouse's income, all that's going to add together and it's going to come up with a tax rate. Now, let's just say for a hypothetical, your tax rate is 20%. So if you make $100,000 in profit, you're paying 15% self-employment tax and 20% ordinary income tax, a total of 35%. So you can see $35,000 right off the top is going to go towards your income tax expense. Now, here's the power of an S corporation. When we have an S corporation, that $100,000 moves off of your return and it files its own return. That S corporation then has to pay a payroll to you. You got to become an employee of your own corporation, which is kind of a headache, but we can do it. So let's just say, for an example, we take $60,000 of that $100,000 profit and we pay ourselves a W-2 paycheck. Now, that $60,000, of course, is going to have Social Security and Medicare tax, and it's going to show up on our personal return as income, right? So that $60,000, we're still going to be paying 35% tax on it. But here's the magic of the S corporation. The difference between the $100,000 profit and the $60,000 salary, that extra $40,000, it is going to be taken back to your personal return as ordinary income, but it's not subject to self-employment tax. And so just do the math here. You're saving 15% of that $40,000. That's a $6,000 tax savings by doing nothing other than electing S corporation. So you can quickly see how powerful S corporation can be, because with just $100,000 in profit, we can oftentimes save $6,000, $7,000, $8,000, even $8,000 on our income tax returns. Now, there is a couple of complications. The first thing I mentioned, you do have to pay yourself a payroll, so we got to have payroll software, etc. And we also have to have the business file its own tax return. But almost always, if you are an LLC or a sole proprietor that can become an LLC, once your profit hits $50,000, meaning once your gross commission income minus your expenses, once that hits $50,000, it's almost always going to be beneficial for you to elect S corporation tax status. It's one of the most powerful and lowest hanging fruit tax strategies that we can possibly implement as a real estate agent. So we need to be taking a look at that. You need to be having that discussion with your accountant. So a couple of things we do want to hit on. There are 4 what we call smart tax moves that you can make before December 31st. And I'm going to go through these real quick, but these are things that in the last 6 weeks here before the end of the year, here's a few moves that you might be able to make that might help you save taxes even this year. S Corp, maybe too late for this year. It might not be, but maybe it is. These are 4 tax moves that you might be able to take advantage of. The first is prepaying your expenses. If you know that you're going to be buying supplies, renewing your MLS, paying for a lump sum of marketing during the year, or maybe you've got a sales coach that you're going to hire and you're going to have them for 12 months. You might be able to prepay those this year. And the IRS allows us to take the deduction on this year's tax return as long as that expense is going to be used in the next 12 months. So as long as you're not prepaying more than 12 months in advance, the IRS allows us to make that deduction this year. IRS considers most real estate agents to be what we call cash basis taxpayers, which means we deduct things in the year that we pay them. And so if you know that this year was just an absolute banner year, and you had more sales this year, you got some big transaction you know is not going to happen last year, and your tax rate's higher this year, you might want to consider prepaying some expenses and take advantage of deducting them at a higher tax rate. The second one, not very common, but happens just occasionally with real estate agents, so we need to mention it, is delaying income. The reason this is even on here, I had a client who a couple of years ago was working on this, real estate agent who was working on the sale of a campground. And her client came to her and said, hey, it doesn't matter to me whether this thing closes December 31st or January 1st. He's like, I don't care. It doesn't make any difference to me. Your commission's going to be $300,000. Do you want to shift that between the years? And we were able to work with her to say, hey, it makes sense to take the income this year versus delay it next year. It's an option, especially if you're working your own transactions. We would never recommend that you're trying to delay a transaction for a client or anything unethical like that. However, if you're dealing with your own transactions, or transactions of a family member, this can be a powerful technique because it could allow us to shift income between the years. The third strategy that you could use this year to save taxes is potentially contributing to a retirement account. If you're self-employed, like most real estate agents are, you can open up something called a solo 401k, a SEP IRA, a single K, and you can deduct contributions to those retirement accounts. And some of those retirement accounts we're allowed to set up after the end of the year, but some of the most powerful ones we have to have set up before the end of the year. So for example, the single K or the solo 401k, if you don't have any employees, it's just you, and you made $300,000 or $400,000 net profit this year, you might want to think about opening a single or solo 401k, because you could put up to $70,000 this year into that plan. And so think about 70,000 times a 30 or 40% tax rate. You could save substantial amounts of income tax this year by opening and funding a retirement account. But a lot of these accounts require them to be open before the end of the year. So get with your advisor, your CPA, to understand if you need to do that before the end of the year. And the fourth one here is buying business equipment. Man, there's all sorts of things that agents are often asking us about. New laptops, maybe it's a drone, and the most popular is a new vehicle, right? If you're purchasing that asset and you place it into service, is what IRS says, meaning it's owned by you, it's titled in the name of your business on December 31st. As long as that happens, you are eligible to begin writing it off this year. And many assets are now eligible for what we call bonus depreciation, where you can write off up to 100% of the cost of that asset. We're often asked about vehicles in particular. The rules around vehicles are pretty complex. It's going to depend on the type of vehicle, what percentage of it is used for business purposes versus personal. However, there are some vehicles that would be entitled to massive bonus depreciation. So if you're in the market for a new vehicle, as long as it's purchased by December 31st, you could deduct it this year. And that is the case even if you're not paying cash. Even if you're financing the vehicle, as long as it's purchased by you, titled in your name by December 31st, it would be eligible to be deducted this year.
Perfect. Yeah, those are some simple but legitimate strategies. So they don't change your income, but they just change when you recognize it. So let's jump on to the next one, planning for profit. We're getting close to finishing up here, so let's finish this strong. So when I first started selling real estate, I treated every commission as just like a bonus check. And when tax time hit, I was scrambling. There's a couple times where the CPA called me and they said, "Hey, you owe twice of what I was planning on paying." So that stressed me out. So what I figured out is what we've come up with, you must tell your money where to go. So there are 3 basic accounts that we feel like each agent should have for their business. You should have an operations account, a tax account, and a profit savings account. The operation this is where the commission is going to land and expenses are paid out of. This is the essentially your main business checking account. This is where most of the transactions are going to take place. Your taxes, we recommend that you transfer 25 to 30% into this account. This is a separate savings account in the name of your business where you'll save money that you'll need to pay your income taxes each year. Here again, we normally recommend agents transfer anywhere from 25 to 30% of their income into this account. This will vary depending on your situation. So talk with your CPA about this. But when you move the money, you'll then in the year, you'll move the money from this account back into your checking when you'll need to make quarterly estimated payments or your end of year tax bill. And just remember, this account should be earning you some interest. It should be invested maybe in a CD or a money market fund. And then the next account you need is your profit savings. We recommend moving 10% here every time you get paid. This is the money that you're setting aside for strategic initiatives, for investing back in yourself or your business. These funds can be used for things like retirement plans, coaching, consulting, sales training. This is the profit that you're wanting to reinvest in the business. Or if you don't have anything you want to invest in, you could take these funds out of the business for additional compensation.
Yeah, so the whole idea behind this slide in planning for profit is it's really an exercise in budgeting, but it's also a somewhat psychological exercise because what we have found is that a lot of business owners, including most real estate agents, have a difficult time with budgeting and telling our money where to go. And so what we're suggesting here is that you have actual bank accounts that are set up for different purposes. So we've got that operations account in the business. We've got that tax account in the business. We've got that profit account in the business. And when we're allocating those dollars, when we see agents moving those dollars from one account to the other, we've noticed the psychological shift that happens and that they become better business owners because they're not fretting as much about their money. They're spending more wisely because they can see what's available. So those are the three accounts for the business that we recommend. But then we also are missing one account, and that's the personal checking account. We often see agents sort of treating the business checking like their personal checking and their personal checking like their business checking is sort of one big slush fund. But we recommend that you've got a personal checking account that's not one of the new business accounts you created. Then this is the account that you're paying all of your personal bills from. This is where anything non-business is going. You're paying your groceries and your household bills. You're paying everything out of that. When you're eating out, you're hanging out on the weekend, you're going on vacation, all of that is coming out of your personal checking account. What we recommend agents do is we recommend agents pay themselves from the business. And so usually we recommend around 40% of the gross commission income move when you're getting it, pay yourself once a month into your personal account and try to live off that dollar amount. Now, we know that that's going to vary depending on the agent, it's going to depend on the month, etc. However, we think it's good practice, good discipline to get into to start having your business, treating yourself like a business owner and paying yourself on a consistent basis. And that's it. We have found that this simple system like this removes like 90% of the stress that a lot of agents feel about cash flow throughout the year.
Yeah, I agree. When you set aside money for taxes and profit first, you finally feel in control. It's not about how much you make, it's about how much you keep. Consistency beats complexity every day. You don't need 12 accounts or fancy spreadsheets. Just commit to doing the basics. Same way you follow up with clients and track listings. Oftentimes, we see agents want to make things more complex and get overwhelmed. They just need to keep it simple. Our advice is to create simple, repeatable system that allows you to move slowly in the right direction. We talk about systems often because we have seen that they work. They work to help you have peace and control in your business, and they help you grow and achieve all of your wealth goals that you want.
Yeah, so just to recap high level what we talked about today. We talked about the importance of tracking your deductions and having good documentation. Remember, you can't deduct what you can't document. There's some low-hanging fruit tax deductions that a lot of agents are missing. Make sure you're talking with your accountant every year, regularly throughout the year to make sure that you're capturing and tracking your deductions. Use software. If you don't hear anything else, use software. QuickBooks Online is great. Mile IQ is fantastic to track your mileage. track and document everything. Keep your books simple and clean. A lot of agents don't have a good bookkeeping system, or they're doing something that's incredibly too complex. Have a bookkeeping system, do it on a monthly basis. Don't wait until the end of the year. Keep it simple, keep it clean. Consider an S corporation. Man, if you're consistently making $50,000 of net profit on an annual basis, you are probably leaving money on the table if you're not considering an S corporation. Yes, there's complexity. Yes, there's additional cost to your accountant. Those are all true. But in spite of that, you are very likely leaving money on the table if you're not considering an S corporation. And then we gave you a few year-end tax moves to consider, things that you might need to do before the end of the year. Consider making those. It's not too late. And finally, pay yourself on purpose. Have a disciplined budgeting system. Now, these aren't complicated steps, but together, these things taken together will really build a solid foundation for long-term financial success for you and your business.
Yeah. And as a real estate agent, you're already helping your clients build wealth by buying real estate. So we found that these systems we lay out is what will help you build your wealth.
Yeah. And so what we've done is we put together a free checklist that sort of summarizes everything we learned today. You'll see that the QR code on the far left side of the screen is called the Year-End Tax Playbook Checklist. That's a checklist that literally goes through what we talked about. You can download the PDF from the website, and it will just help you walk through and refresh your memory on some of the things that we're talking about. You can also see we have a free tax strategy guide, which lists the top 10 deductions that agents often miss. There's a QR code for that as well.
Yeah. And if you guys, we also have a free strategy call in here. So if you guys want to see how we might be able to help you implement some of these things into your business, feel free to, scan that code. We can help you jump on, no obligation call, and we can see if we can help you guys out.
Yeah. So thanks so much for having us. We'll stick around. If there are questions, you can throw them into the chat. You can always reach out to either one of us. It's Michael at agentsaccountant.com or Jordan at agentsaccountant.com. Shoot us questions if you got them. We're always happy to try to help agents out however we can. But hope you all have a great rest of your week and go make those tax smart moves that will pay off big for you.
So Michael and Jordan, I do have a quick question. So on the S Corp, in Florida, the DBPR will allow you to be like an LLC, PC, or PA. And then you can have that entity, and then they can elect to be an S Corp. Is that correct?
Yeah, that's exactly right. Yeah, the key to S corporations is you have to have some sort of legal entity. And so if your state level, if your state regulations allow you to operate your business inside of an entity, then that entity as an LLC or a corporation could elect S corporation status. You're exactly correct.
Okay, cool. All right, well, let's throw it out and see if anybody else has any questions. Maybe type them into the chat box, guys. See if we get any.
Yeah.
Everybody good? Well, we really appreciate, Michael and Jordan. I would take advantage of their free strategy call. Great guys. I think it was very, at least I learned a lot, very informative. So thank you so much. And any last questions, type them in the chat and we'll happily answer them for you. Thank you, Melissa. We appreciate it. I'm new to real estate. Juliana says, I'm new to real estate and have paid all the dues and partnering material, but don't have any sales. Can I still deduct those expenses?
Yeah, it's a great question. We get this pretty frequently on this session. The answer is yes. So what happens is, you were likely structured as a sole proprietorship, which means it's probably under your personal name. That's typically how folks are when they start. And so all the items of business, all of your income and all of your expenses are going to be included on what's called a Schedule C, which is a schedule of your personal tax return. Okay, so that's going to be a schedule that's included on your personal 1040. And that Schedule C is eligible to show either a net profit or a net loss, meaning you can report all of your expenses even if you don't have any income. What happens is that net loss will then offset other income that you might have on your return. So for example, you got a W-2 job, you're sort of a standard 9 to 5. The loss from the real estate sales business will offset some of the income potentially from your other job. Now, let me just say there's potential limitations your accountants are going to need to look at. However, in general, yes, it's deductible. The only time that we would find that it becomes not deductible is if you start to have losses in more than 3 out of 5 tax years. So if you're consistently reporting a loss, the IRS begins to question whether or not you are actually running, and I'm going to use air quotes, a business. And instead, the IRS starts to say you're running a hobby, and IRS does not allow deductions for a hobby. However, that's often not the case. Most of the time, agents have losses in that first year when you're incurring expenses just like you are. But as soon as you get that first commission check rolling, that won't be a problem moving forward. And so you will be able to deduct those expenses, get that information to your accountant, who will put that on your return, and will be able to take that loss against your other income. But thanks for the question.
That was a very good question. Appreciate that. Any other questions? Morris says, I just created my LLC and opened a business account, but don't know if I will be able to do my taxes under the LLC.
Yeah, that's another good question. So there's a couple of steps that you need to make sure you're taking. Make sure that your brokerage, make sure these guys know that you're operating as an LLC. Make sure you're eligible to be operating your business as an LLC in your state. So assuming you've done that and you've got the business functioning with the brokerage as an LLC, you should be able to be getting your commission checks paid to the LLC and deducted into that business account. And then honestly, as an LLC, the default tax status as an LLC is as a sole proprietor. So just like the question that we answered previously, and I said that all of your income and expenses as a sole proprietor are included on Schedule C on your personal return, all of your income and expenses as an LLC, assuming that you're the only owner of the LLC, and there's not other owners, but assuming that you're the only owner of the LLC, all of those income and expenses are included on that Schedule C as a part of your personal tax return. And you just put the name of the LLC at the top of the form. It's fairly straightforward. Your accountant should be able to know how to do it. If you're preparing it yourself, you should be able to see that. But if you can't see it, shoot us a note. We'll kind of walk you through it. But yes, your LLC will file on a Schedule C as a part of your personal tax filing.
Now, if you do set up an LLC or then you designate it as a subchapter S, can you own 50% of it and then someone else own half, or do you have to own 100%?
That's a great question. Let me give you 2 answers. The first of which I'm very knowledgeable on, the second of which I'm going to plead ignorance on and defer you to somebody else. So the first answer is yes, an entity in the eyes of the state, either a corporation or an LLC, can be owned by multiple individuals. It can be owned by any number of people. So more than one. In terms of if you're hanging your license in the name of the LLC, you're going to need to check specifically with your state licensing regulations to determine whether or not that entity, which has got you're hanging your license in that entity, whether or not that's eligible to be owned by multiple individuals. And honestly, your insurance company will probably have to be involved as well. So I don't know on that one. You're going to need to seek kind of legal counsel, talk to your brokerage about that specifically. But from a legal standpoint, in terms of is it possible, the answer is yes. Multiple people can own an LLC.
Yeah. Amara mentioned she just requested the DBPR to add the LLC. So basically what we need to be able to pay you as the LLC is that your license reflects that, right? So they change your license from Philip Wade. If it was my license, I'm not an LLC, but if I was, I would be Philip Wade LLC or PA or PC. And then that's how we, as Dalton Wade, pay you. So you need to know us, let us know that, we check that, and then we're able to pay you that way, and then you're able to deposit into your business account. And she's mentioned the bank asked, how I was going to do my taxes. I told them as an S corp. Now again, Michael will comment here, I'm sure. you have to elect to become an S corp. Is that correct, Michael?
Yeah, that's exactly right. So the default as an LLC, your default tax status, if you don't do anything, is to file as what we call a sole proprietor, is just a part of your personal return, and you would not be an S corporation. Now, I can tell you, if you're just starting out and your net profit from the business is under 50,000, there are probably likely reasons why we would not want you to elect to become an S corporation. So you're going to need to talk to your accountant to determine whether or not it makes sense for you to elect to become an S corporation this year. And to be quite honest with you, the bank, they don't really care whether you're filing as an LLC or an S corporation. That's typically a check the box thing for their records. What I would do is, if you determine that you are not, you with your accountant determine that you are not going to be an S corporation this year, simply let the bank know and say, hey, I checked the wrong box. My accountant said I'm not going to be an S corp. I'm just going to be a sole proprietor LLC for this year. That's not going to be a problem with almost any bank. So it's, even if you did that, not all is not lost. Simply get in touch with them and talk to your accountant about what makes sense for you this year.
Now, if you were an LLC and say you didn't make the election, right, but now another year has gone by and you say, oh, now I want to be an S corp. Can you make the election in the future?
Yeah, so you can make the election at any time. However, there are certain, meaning if you don't make it for year one, you can still make it for year two, you can still make it for year three, etc. So we can make it down the road. And we can even technically, if you want to make the election for a given tax year, you're supposed to do it by the 15th day of the third month, I believe it is. So you're going to have like 2.5 months, 10 weeks to make the election. However, talk with your accountant, because we can make late S corporation elections. We do it all the time. Almost every S corporation election is made late. So again, all is not lost. Yes, you can make it at any point in time, for just about any given year, with some limitations. But yeah, and down the road is totally fine if you want to do that.
Awesome. Very, very, very helpful. All right. Anybody else with any questions? I think we're getting some really good feedback, some good answers. I've learned a lot. We appreciate that. Cool. Anybody else type in any other questions? Well, Jordan and Michael, thank you so much. Very informative. I know I learned a lot, and I'm sure everybody else did. Guys, if you don't have a someone helping you with your taxes, I mean, you want to keep that money, not give it to Uncle Sam, feel free to reach out to Jordan and Michael, and I know they certainly can help you. All right, Juliana, thank you. Appreciate that. All right, guys, anything in parting?
That's it.
No,
So
we appreciate you having us.
Yeah, we're going to do it
appreciate
again.
you guys having us.
We're definitely going to do it again. Now that we got you, how about Tuesday, December 2nd? I know next week is a holiday, so that probably isn't good, but how about, same time in 2 weeks?
Yeah, let me check the calendar. Yeah, let's check the calendar. We'll circle back, but most likely.
All right, shoot us an email, and we'll I think everybody within Dalton Way would be happy to hear what everybody that was on the call learned tonight. So thank you so much, and appreciate everybody being here.
Perfect. Thank you so much.
Thanks, Phil.
Do let me know. All right, guys. Bye. Thank you.
And bye-bye.